Something just broke in the bond market last week, and Wall Street is hoping you don't connect the dots, not because it's complicated, but because once you do, you'll realize the entire financial system Americans rely on is flashing a warning signal that history has never ignored. In just 30 days, the 10-year Treasury yield surged from 3.97% to 4.44%, a 47 basis point spike. The 30-year, sitting at 4.9%, knocking on the psychological 5% level. And in the bond world, that level isn't just a number. It's a trigger, because behind the scenes, something else happened that almost nobody is talking about. Bond traders have a name for it. They call them bond vigilantes, and for the first time in over a decade, they're back. 2-year, 5-year, and 7-year Treasury auctions all came in weak at the same time. And primary dealers, the institutions forced to buy what nobody else wants, were left holding nearly a quarter of the supply themselves. That's not normal. That's a signal. That number. It's nearly double the historical average. Let that sink in. Emergency buyers had to step in just to keep the system functioning, and now the market is demanding higher compensation to lend money to the United States government. This isn't a technical glitch. This isn't noise. This is a message, and it's a message written in a code most people don't even realize exists. But by the end of this video, you will. You'll understand exactly what that message is saying. Exactly why it follows a pattern that has already devastated entire economies before, and most importantly, exactly what you need to do right now, before the next phase of this cycle unfolds. Stay with me, because this matters more than people think. Before we go any further, you need to understand the mechanism, because everything you're about to see only makes sense through one lens. A 4-stage cycle that every bond market crisis in history has followed. No exceptions. Stage 1. The illusion of stability. Cheap money flows. Deficits look manageable. Nobody talks about risk. Leverage builds quietly. Stage 2. Overextension. Debt becomes unsustainable. Interest payments rise. Foreign buyers hesitate, but markets still look fine on the surface. That's the trap. Stage 3. The trigger. A shock hits: inflation, policy mistake, failed auction. Confidence breaks. Buyers disappear. Yields spike. Everything reprices at once. Stage 4. Forced resolution. Default, inflation, currency collapse, financial repression. Sometimes all at once. History has already shown us how this plays out. 1994. Strong economy, low inflation, markets confident. Then the Fed moved. Just 25 basis points, and everything unraveled. Within months, rates surged, yields exploded, and over $1 trillion was wiped out. Nobody saw it coming. 2022, same setup. Easy money, massive deficits, then inflation hit. The Fed hiked aggressively and global bonds crashed 11%. Fastest collapse in modern history. Same pattern. Every time. That doesn't sound catastrophic until you understand what it actually represents. This was the largest bond market loss in recorded history. Bigger than 1994, bigger than 2008. Over $2.5 trillion erased in a single year. And once again, most investors were caught completely off guard, stuck in stage 1, convinced the Fed would always step in, convinced this time was different. It wasn't, it never is. Now let's go somewhere Wall Street doesn't like to talk about because it's too revealing. 1998. Russia. Massive deficits. Short-term debt. Foreign investors chasing high yields. Everything looked stable until it didn't. Oil collapsed. Revenue vanished. On August 17th, Russia defaulted and devalued overnight. Billions were wiped out instantly, but it didn't stop there. It triggered the collapse of LTCM, a $125 billion hedge fund run by Nobel Prize economists, holding over $1 trillion in derivatives. The entire global financial system nearly broke because one bond market warning was ignored. Now bring that forward to today. The US spent over a decade in stage 1, near zero rates, cheap debt, endless liquidity. But here's the part people forget. Stage 1 always ends. Stage 2 didn't start quietly, it accelerated. Since 2021, The US has entered full-scale overextension, and the numbers are staggering. $39 trillion in national debt. Read that again. $39 trillion, a projected $1.9 trillion deficit in 2026 alone, nearly double the 50-year average relative to GDP. And here's where it breaks. For the first time in modern history, the US will spend over $1 trillion a year just on interest. More than its entire defense budget. Think about that. More money paying for the past than protecting the future. Debt to GDP is already at 101%, heading toward 120%, higher than post-WII levels. But this time, there's no industrial boom, no population surge to grow out of it. And then comes the math nobody wants to talk about. By 2031, interest costs will exceed economic growth, what economists call R greater than G. That's the point where debt stops being manageable and starts compounding out of control. And now, stage 3. The trigger isn't coming, it's already here. War, oil, inflation. In late February 2026, conflict in the Middle East pushed oil from $80 to $126 in days. Energy drives everything, and inflation destroys bonds. This is where the system starts to crack. Here's how the spiral begins. Inflation rises, bond investors demand higher yields. They sell existing bonds, prices fall, yields surge even more. That feedback loop, it's already in motion. Trigger number 2, the auction breakdown. Last week, 2-year, 5-year, and 7-year Treasury auctions all came in week at the same time. That almost never happens. Primary dealers were forced to absorb nearly 25% of supply, more than double their normal share. And even then, yields had to be raised last minute just to clear the auction. That's what traders call a tail. It means demand wasn't there. Since February 27th, yields across the curve have surged over 40 basis points. The 10-year jumped to 4.44%. The 30-year is approaching 4.9%. These aren't normal moves. This is stress in the most liquid market on Earth. Trigger 3, Fed paralysis. Powell says wait and see while inflation is already above target before oil shocks even hit. And now the bond market is pricing rate hikes, not cuts. That's a problem. Because higher rates mean higher costs on $39 trillion debt, already over $1 trillion a year. Volatility is spiking. The system is cracking in real time. This is stage 3. The trigger has been pulled. If this pattern continues, and it always has, we're heading into the most toxic economic environment possible: stagflation, rising prices, slowing growth, and no easy way out. The S&P 500 is already down 7% this year. The VIX is above 30, fear levels in the 95th percentile. Mortgage rates are climbing back towards 7%. That means every American is losing purchasing power in real time. Businesses pay more to borrow. Growth slows. The squeeze is real. Now here's the breaking point. If the 30-year yield crosses 5% and stays there, we could see a full-scale repricing of risk across markets. The kind we haven't seen since 2008 or 2022. And here's what should keep you up at night. The US has to refinance $10 trillion of debt this year at higher rates. That means exploding interest costs, widening deficits, and more supply hitting a bond market that's already struggling. Now let's kill 3 dangerous myths. Myth 1. This time is different. It never is. Myth 2. The Fed will save us, not with $39 trillion in debt. Myth 3. America is protected. Foreign buyers are already pulling back. The bond market is in control now. And it only listens to math. When those limits get tested like they did last week, the system doesn't show strength, it shows stress. Primary dealers stepping in as buyers of last resort. That's not confidence. That's a warning. The bond market doesn't care about American exceptionalism. It cares about math. And right now, it's questioning US credit. So what do you actually do? First, know your risk. Long-duration bonds. In a rising yield environment, they get crushed. A 1% move can wipe out 20% on a 30-year bond. That's not theory. That's duration. Second, go shorter. Short-term treasuries are yielding 4% without the price risk. Third, think real assets. Inflation doesn't destroy everything, just paper claims. Fourth, watch 5% on the 30-year. If that breaks and holds, the next phase accelerates. Fifth, understand housing. Rising mortgage rates are already killing affordability. Sixth, the Fed is trapped. Raise rates, debt explodes. Cut rates, inflation runs. Seventh, volatility is rising. And when bonds move, everything else follows. Eighth, stay liquid. In chaos, liquidity wins, because right now the bond market isn't whispering, it's screaming. They were comfortable. They were confident. They believed this time was different. They were wrong. The bond market was right. It's always right. 1994, over $1 trillion wiped out. 2022, $2.5 trillion erased in a single year. 1998, Russia collapsed before the system admitted it. And now it's happening again. The signal is already here. The only question is, are you listening? If this gave you something your financial advisor didn't, something the mainstream isn't telling you, then you already know why this matters. This channel exists for moments like this when the signals are clear, the pattern is repeating, and the window to act is still open. Watch what comes next. Because this story isn't over. The investors who act now will look like geniuses in 2 years. The ones who ignore it won't understand what they missed. Don't be that person.